This conference will now be recorded.
It should be an assignment. If you look in assignments, you should see your name. The groups are color-coded, and you should see the journal entry that you've been assigned to present. So I'm not taking up anything. You present journal entries to me. And every time there's an incorrect answer for a team, then that team loses a point. So I think you all are smart. As smart as you all are, I should be able to determine how to make sure you're, because we're prepping you for the real world. And
the question comes from the 73, 78 journal entries?
no, these are the journal entries on page 84. 84 through 88 of the primer. This is a different set of journal entries.
And where can we find these journal entries, sir?
In the primer on pages 84 through 88.
In our book, or is it on Blackboard?
In the book here.
So we have to buy that?
Yeah, most courses have a book. And let me just indicate that former students, when we were in the old days of whiteboards, and I wrote awful, they said, you need to put this in a book because we can't listen to you and take notes on your awful writing and learn accounting. So that was a suggestion from former students. And so what I did was to get all my notes and group them up and put them in this book. These are notes, so I don't make any money. I'll just make that clear. I don't get paid 1 cent, But this is to have the notes organized so you can look at these notes and go through. And I use them in Principles 1 and in Principles 2. But I was putting these on the book. So this is a recommendation of former students. Go ahead and put it in it like this. So it's all together. Sometimes you got to use, certainly you can put things in sections of Blackboard, but I think this method is a lot better. Okay, we need to look
on the syllabus.
Pardon? It's on the syllabus.
It's on the syllabus. All right.
Generally accepted accounting principles. And so we're beginning to look at the theory behind what we're doing. So we've gone and done things. Now we're coming back and looking at the theory. And there are 4 groups that play a role in developing accounting principles. First of all, the Securities and Exchange Commission. After the Great Depression in the 30s, where companies were just creating all kinds of statements using no rules, they were charged with coming up with some principles so that financial statements would be objective and understandable, and we could know how a company was doing. The Financial Accounting Standards Boards, which consist of the practitioners, do most of the work. So the Securities and Exchange Commission is farmed that off to them. They have the practitioners and professors, and so most of that work is done by the Financial Accounting Standards Board to create the standards. As municipalities began to go bankrupt, the Governmental Accounting Standards Board was created so that, government, states, cities would have to, follow uniform rules to keep themselves out of trouble and from going bankrupt. Then we have the International Accounting Standards Board. Well, most companies, a lot of companies in Houston operate internationally. And so we need standards so that the financial statements from a location in China is the same as one in Chile. You got the same rule, the same as one in Germany. And then you have the issues already of exchange rates. And so the International Accounting Standards Board sets the standards for companies outside the US, and they try to coordinate with the FASB so that we have uniform standards. Otherwise, the financial statements would not mean that much. There are and of course you should know these entities. There are 15 generally accepted accounting principles you need to know. We won't be testing on these until after midterm. But some are going to come into play as we work with adjusting entries. And the first one is this recognition principle. And the recognition principle states that income and expenses should be recognized in the same period in which they were accrued or occurred. So when we earn the income, journal entry 15, or when we incur the expenses, we haven't done a lot with accrued expenses yet. And this is where adjusting entries come in. But this recognition principle says that we recognize revenue when it's earned and we recognize expenses when incurred. Then number 8, the matching principle. This principle states that expenses should be recognized and recorded when those expenses can be matched with the revenue that they help create. So let's look at this example. There's a company that pays its workers on the first day of the month following the month in which they work. So in December, revenues of $400,000 were earned by this company, and they got a December 31st year in. The workers work, and and so the company incurs $75,000, but they're not paying those workers until 2021. And what the matching principle states is that we got to record these expenses, even though not paid in 2020, so they match up with the revenue of 2020. And realistically, you don't want, because you pay tax on revenue, so you don't want 400,000 in revenue, pay tax on that, and then get the write-off the next year. You want the revenue and expenses in the same year. And finally, accrual basis accounting, which is a summary of what we talked about. We look at these transactions and events, and whenever there's an impact on economic resources and claims, etc., we recognize those in the period that they occur. That journal entry 15, we recognize revenue when it's earned, not when the cash is paid. That's accrual basis. The same thing with expenses. We're going to recognize expenses when incurred, not when they're paid. So look at the information on accrual basis accounting, the matching principle, and the recognition principle. And these are going to guide us in our discussions as we work on adjusting entries. Okay, the accounting cycle. And we did steps 1 and 2. Analyzed transactions. We made journal entries. Then we did steps 3 and 4. We posted to the ledger and we prepared the trial balance. We skipped steps 5 and 6 and went on to steps 7 and 8. We're coming back now to step 5, making adjusting entries. We don't have to do a preliminary trial balance, but we can wait until we make adjusting entries, which are journal entries that have to be posted. Get a trial balance after the adjusting entry. So we have the regular journal entries, we have the adjusting journal entries. They're the same. They have a debit and a credit. They equal out. And they have to be posted to the ledger and a trial balance prepared afterwards. So now as we work on financial statements, we'll be adding in what's called adjusting entries. We'll get a trial balance that has other types of journal entries on it, where the journal entries have been updated to reflect the rules of adjusting entries. And then we prepare this. So once we get a trial balance, 7 and 8 remains the same. We just got to put some more journal entries in here that we have not talked about. So let's see what we get. Okay. Adjusting entries. So this is chapter 3. And it talks about the need for adjusting entries. And it's very similar to what we talked about with those theoretical concepts. So review the theoretical concepts. And it's going to ensure that the revenues and the expenses, the assets and the liabilities are correct without adjusting entries. The assets are not correct, the liabilities are not correct, and the revenues and expenses are not correct. So that's the purpose of adjusting entry. We have accrued revenues. That's similar to a type 15. And we have accrued expenses. We hadn't talked about those. Deferred expenses are prepaid assets where we buy something. Depreciation expense. Deferred revenue where we get revenue in advance. Doubtful accounts. So we'll be going through and looking at examples of all of these. But this is just giving you overall types. Let's look at a simple example of the rationale behind adjusting entries. When we did our preliminary problem on page 37 and 38 to learn about journal entries, we had a purchase of supplies for $1,000, and then we had a purchase of supplies for $8,000. So that was the situation. A purchase of supplies for $1,000, debit supplies, credit cash. A purchase of supplies for $8,000, debit supplies and credit accounts payable. Now we're told at the end of the year we only got $3,000 in supplies. We only have $3,000 in supplies. So if we have in the T accounts 9,000, but we only have 3,000, what do we need to do? What do we need to do? We need to make an adjusting entry. We had 3,000 in supplies. We had 9,000. Now we only have 3,000. Suppose you had $9,000 in the bank at the start of the year. You only got 3,000 in at the end. What happened? You had $9,000 in the bank account at the beginning of the month. You got 3,000 now. What happened?
You lost money.
How have you lost money? Is that what you say when you spend money?
Yeah.
So you spent the money. So if you had 9,000 in your account, you start off with 1, you added 8, then you only got 3. That means how much money did you spend?
$6,000.
Then $6,000. So that becomes the adjusting entry. So this is what an adjusting entry does. An adjusting entry comes in and correct the account's assets would make this adjusting entry, and then the supplies would get an expense. When we started off, supplies were just sitting at 9. There was no supplies expense. When we make the adjusting entry, because 6,000 has been utilized, we debit 6,000 to supplies expense. This is now an expense account that's going to go on the income statement. And we credit supplies for 6,000 to get it to its $3,000 balance. So a couple of things you're going to see about adjusting entries. Number one, I'm not telling you the amount. You got to calculate it. So before, all you had to do is get your journal entry type. But now you got a calculation to make with adjusting entries. Secondly, we had a preceding entry to buy the supplies that involve cash, and then another one that involves buying the supplies on account, which you eventually have to pay. But when we get to this adjusting entry, cash is never a count used in any adjusting entry. And I'm going to say it a second time. When we make the AJE, the adjusting entry, I should not see the cash account. And finally, for the third time, when you make an adjusting entry, cash is never in that account. The second thing, an adjusting entry is always going to involve an asset, a balance sheet account, and an income statement account. An adjusting entry will always involve a balance sheet account, not cash, and an income statement account. So when you look at this AJE here now, when you look at this, what is the income statement account? And what's the balance sheet account? Now, if you look at your chart of accounts, what do you see? You see a 130 here and a 680. If you see this 130, that is probably what kind of an account?
That's what account you said, sir?
That's what I'm asking. One of the rules is that a balance sheet account and an income statement account is always included in the adjusting entry. So I'm asking for the balance sheet account in this adjusting entry. So if you look at this adjusting entry, What is the balance sheet account and what's the income statement account? The two accounts that are in bold,
Would it be supplies and supplies expense?
those, which one is a balance sheet account and which one is an income statement account?
The balance account is supplies expense.
Supplies expense is the balance sheet account.
Supplies expenses, the balance sheet account. Let me go through here. Let me go back. Evidently, you all have thrown away your chart of accounts. Now, balance sheet accounts are on the left, income statement accounts are on the right. What do you see?
So supplies gonna be on the balance sheet side. Income statement is gonna be the supplies expense.
Correct. So when you have an adjusting entry, it can't be cash, but it needs to be a balance sheet account from accounts receivable all the way probably down to deferred tax. And it needs to be an account on the revenue side, revenues and expenses, income statement accounts side rather, from sales all the way down. So always keep that in mind, please. Okay, so we're going to begin by looking at prepaid expenses and unearned revenues. So we're going to do all of them today, and then we'll go to accrued revenues and accrued expenses next week in terms of the type of account. So why don't we go to unearned revenues first if we can. And unearned revenue is a situation when a company receives cash prior to the performance of services. Okay. Airline companies, magazine companies, shoe manufacturers, game stores. Here, people pay the company in advance. When you get the cash in advance, that's a good situation. You haven't earned the revenue yet. You have not earned the revenue, but you got the cash. So companies like that. So let's assume that GameStop collects $50 in advance from 200 customers for a game that's going to arrive in 2 months. So GameStop is getting $50 from 200 customers in advance. People got to have this game. So how much money is GameStop getting?
$10,000.
All right, $10,000. What type of entry we gonna make? What journal entry type is that gonna be?
Sale on account.
You got the cash already.
Oh, type 2.
No,
Shit.
stretch out. It's got to be 1 through 6.
Type 3.
No, you struck out.
Is it a forcer?
It's a
Type
type
4.
four. What does 4 say, Daniel?
Income received in advance?
Income received in advance.
I don't know why I got that one marked out on here.
Okay, at this stage, you got to use all the accounts. So from now on, you got to use them all.
All right.
So we're in the second round of the playoffs now. So unstrike them out. So when they get the cash, they're going to debit cash and credit unearned revenue. Isn't that what the journal entry say? Isn't that what type 4 says?
Say cash and unearned income.
Well, unearned income, unearned revenue is the same thing. Now, what kind of an account is unearned revenue? Tell me that. What kind of an account is unearned revenue?
Would that be sales returns?
Would it be what?
Sales returns.
Nothing been returned yet. Chart of account, come up again. So what type of account is unearned revenue or unearned income?
A balance sheet account.
It's a balance sheet account and it's a liability account. We got the cash, but because we haven't delivered the goods, this money is not earned. So it's an unearned account and customers can request their money back. So it's a liability account. Now, what happens when the customers come in? So right now we got 10,000 in cash, 10,000 in unearned revenue. That's where we are. 2 months go by, everybody come in and gains come in, everybody come in and pick them up. What we gonna do? Right now you have an unearned revenue account with 10,000, got the cash, but the revenues has been earned now. So we're gonna make an adjusting entry, debiting unearned revenue and crediting sales. It's no longer a liability. Once the company delivers the goods, it can debit unearned revenue and credit sales. And now you can't get your money back. You got your goods, you know, and we're ignoring the defect part of it. But you have your goods. The company now can recognize the income. So this is not on the income statement yet. And the company wants to show its income. That's the goal. But it's nice to run a company where you can get your cash in advance. If we don't make that entry, what? Unearned revenue is overstated. It should be zero. Sales are understated. So that's why we make the adjusting entry. Daniel, any questions on that adjusting entry?
Sir, so like, how do you know when to make a adjusting journal entry? Like, when do you know exactly when to make one?
You will have, paragraph like this. Well, you'll have one where you collect the money. Then you have another where the gains arrived and were picked up. So on the first one, you make a journal entry, Then you have this and another transaction. So these are transactions. So your first transaction type is here. Okay, so I'll put that in yellow. That's a transaction. That's a financial transaction that warrants a journal entry. Then when the gains are picked up, that's another transaction. So two transactions. In the first situation, you get your money in advance. The company is happy. GameStop's very happy when you come in there and pay them in advance, or Nike or whatever. They debit cash and credit unearned revenue, and they happy, or unearned income. Then when the shoes come in, or when the game comes in, you come in and get it. They take it out of the unearned account and put it in the sales account. So you're gonna have one statement like this, the one in yellow. That's when you make the first journal entry. Then in a separate line, you have the fact that they picked it up. You make the second journal entry. That's a good question. You have to read and calculate. Any other questions?
Was there a description for the one for supplies there?
So what now?
Was there a description like how it is for the GameStop? Was there a description for the ones for supplies in the?
We moved it back
for-
to supplies. I wanted to make sure you were gonna be ready on Tuesday. So you ready for Tuesday now, right? Good, because that's what we're starting.
Wait, what's Tuesday?
Tuesday's when what's that? The yellow team. That's when the yellow team start making journal entries from those 40 journal entries on page 84 through 88. That's when we started to make we started off making journal entries. We're gonna come back and make some more now. They're just adjusting entries, and you got to calculate the dollar amount. But I'm confident that these teams want to win the game.
Sir, why does yellow have to go first?
Well, somebody had to go first. And maybe the first one might be easier. I don't know, So yellow's going first. And I'll say them hard ones for red, and they go last, so they have more time to think about it. They'll have a little more work to do.
I have a question.
Yes.
What does the X mean?
X mean you took the quiz. So I didn't want to waste my time assigning these to people who didn't take the quiz and all of that. So I just assigned them people who took the quiz. So you only have to worry about people who got an X, and they should have a journal entry number. And so, teams get together. For people who need help, they have a source of help. And for people who help people, you learn it better, because when you have to explain something to someone, and then this is training for when you are a manager on a job, you got to teach people who work with you. And I got to get my replacement for Joy. So y'all are interviewing to replace, y'all are practicing to replace Joy. She graduates next spring. So I need a replacement so I can see how you all are doing. Okay.
It won't be me.
Brooke, that's why I had to. Well, you might. I'm not gonna say anything.
I have a question.
Yes.
When are we going back to in person?
class, but it's a lot easier to understand when we're in person.
Well, we'll talk about that at the end of the class. In certain regards, when we're in class, everybody's there, everybody's paying attention. But the same thing is on the screen. Okay. And so you got, so you're still gonna, I'm just saying, you got to be able to operate either way. In the environment we're in now, you got to be able to operate either way in general. And so you just can't say, well, I want to do it a certain way, because the virus dictates that. And of course, when we're in the class and then we had a person or two get COVID, then people couldn't get tested. Well, COVID's slowing down, but it's still there. And Republican states don't show they will not have the appropriate amount of numbers. So that we go back, everybody needs to be tested. So we get that date. So everybody's got to be tested before we go back. Then we go back, and if someone contacts the virus, if we had a small class that didn't take up all the room, that's one thing. But when we're in close contact, it's a whole different thing. But we'll talk about that. But to a certain extent, it's easier for me to teach on campus. And so we'll see, but we just have to have safety precautions in place, because we don't have social distancing, okay? We do not have the social distancing. Prepaid expenses. And what I'm saying though is that, you're always going to be learning after you graduate. And I can tell you most of your learning is going to be virtual in the future. Once you go to a big meeting in a hotel and everybody will be there, and you'd have training. That's not going to exist, pretty much in the future. So whereas that may work out, you got to adjust to say, I'm going to do it whatever the format. That's what you got to be able to do. Okay, so let's look at prepaid expenses. And when you buy assets, supplies, all the way over to automobiles and things like that, those are prepaid expenses. Eventually, they got to be expensed. And so they need to be producing revenue. So you don't buy anything in a business unless it's gonna, help in producing revenue. So all of those assets, other than cash and receivables, inventory, supplies, insurance, they eventually end up on the income statement as an expense. You got to have revenue to cover that. When we have a prepaid expense, there's always a prior entry to buy the asset. Prepaid expenses, they either expire with the passage of time, or through usage. So you have some like prepaid insurance, then that go by time. You have others like supplies that are utilized based on usage. If you don't make the adjustment, The assets are overstated and the expenses are understated, as we talked about for supplies. And so let's look at this first situation. And what you have to remember, just in terms of going back, we don't have whiteboards at school anymore. So I guess, so there's ways to go, and I just try to have all my examples ready. But it's not like the professor goes to a whiteboard. They've eliminated those. And they expect us to teach like this. That's why those screens are in every classroom, and that's university-wide. So you have supplies such as paper, pens, okay? And so assume that we purchase supplies of 5,000. We take an inventory at the end of the period, only 2,000 in supplies are there. So if we bought the supplies paying cash, what would that journal entry be? If we bought the supplies paying cash, then y'all just make a journal entry buying some supplies. Well, hopefully you debit. So hopefully you would debit supplies.
Debit supplies and credit cash.
Yes, thank you. Now, so we make that entry. Then we get to the end of the period and we count our supplies. We only have 2,000. So what are we going to do? So this is 2020. We buy $5,000 in supplies. And then we get to the end of the period. We only got 2,000. An adjusting entry is now needed because we no longer have 5,000 in supplies. We only have 2,000. So what is that adjusting entry probably going to be?
Would you do supply expense for 3,000 and then credit the supplies?
That's correct. So that's an adjusting entry. I think that may be 13. And so once we do that, then what? There's no longer 5,000 in the supplies account. How much is in the supplies account?
2,000.
2,000. Are there any questions on that? So yellow team, are you all ready to handle this?
But I'll take some time this weekend to try to figure it out.
Can you re-go over that?
Are you gonna post this video on your YouTube today so I can look back just to make sure? Yeah, you're gonna post it today.
We'll post it today.
Okay.
It'll be sometime, early evening because it has to be recorded and blah, blah, blah. Then it has to go in the Blackboard. So I can't go out of class and post it, okay? It's about a 3 or 4 hour process, but I will put it in. Okay. So we buy the supplies, debit supplies, 5,000, credit cash. We take an inventory, only got 2,000 at the end of the period. So a bunch of the supplies are gone. So that's 2021. So here we are with 2,000 in supplies, okay? So that's 2020, and we got 2,000 in supplies. Then we go to 2021, and we buy 8,000 more in supplies. So let's look at what's happened. We bought 5,000 in supplies in 2020. We utilized 3,000 and made this adjusting entry. We come to 2021 and we buy 8,000 more. And then we're told that the balance in supplies is $4,000 at the end of 2021. So here's 2020. We now at 2021. What's our AJE going to be now?
Supplies expense 4,000, and supplies 4,000 as well.
All right, last year we had 5,000. We spent 2. So if this is your bank account, how much money would you have in the bank on January 1st of 2021? If this were your bank account?
So we spent the 5,000,
No,
but no, we got 5,000 and then we spent 2,000.
we spent 3,000.
Okay, we spent 3,000.
Got 2,000 left.
Got 2,000, but we're adding the 8,000. Is that rolling over?
Right, that's rolling over.
So we have
Oh, you have
10,000.
6,000 left.
So yeah.
We have 10,000 in there now. Says 4, so that's correct.
Okay.
The amount would be 6,000.
Yeah. I'm from 6,000.
Because you have to pick up the beginning balance. So we're just saying that when the years roll over and you're making this entry, there's the preceding balance that you got to pick up.
Will it always roll over?
Does your bank account roll over every year, every month?
Okay. Yeah, just
So the supply is the same way. It's going to roll over every time. So we'll stop here. And so we'll pick up with you all making adjusting entry once you start on these. Now remember now, just a couple weeks ago, y'all couldn't make an income statement or a closing entry. So this is learning something else. So we'll get there. Okay. What was the exam question that you all asking me about?
the last one. It was number 6.
Wasn't
I
six?
couldn't get the balance sheet to balance out. They were both different, so I thought I did something with my retained earnings. So I was wondering if you could just go over that.
Doing number 12.
What?
You'd have been doing number 12, not 6.
What do you
No,
mean?
we just finished doing we just turned in number 6.
We
on
turned in
Tuesday.
number 6, but not that one, not the financial statement. It was the trial balance.
Oh, the trial balance number 6.
Yeah.
Couldn't get it to balance.
Mm-hmm.
Let's see where it is.
Well, I couldn't. I don't know about anybody else.
I had the same issue.
I made it all the way to the balance sheet, and then it kind of got messed up.
It wasn't balanced?
No, it wouldn't balance. I tried different ways. I thought I had did my journal entries wrong, so I tried it different ways and it still wouldn't balance out.
Yeah, same here. I even called somebody and we did it together, and we made it. We both made it to the end, and we made it to the balance sheet, and we couldn't get it.
I tried outside the box things like you would think. It did not work still. Okay.
So I think something is wrong. You should give us all 100.
Yes, sir.
Okay, so we talking about.
I like that idea.
Good idea.
We need an effort grade in this class. What?
I was stressed. It stressed me out.
Stress, sir.
Okay, so I'm pulling up 6. Pull up. Did you get the trial balance to balance?
I did. I got all of it to balance.
Yeah, I got the trial
Yeah,
balance. The
same.
balance. It balanced out.
The only thing that didn't balance was like the retained earnings part at the end, like the EP and stuff.
Yeah. All right, let's look at this. Okay. So here's someone who worked that problem, and they had 2,000,002. They did an income statement. Okay, you have less sales returns and allowances. So sales returns, I think I did see that somewhere. That doesn't, sales returns on the sales, but they didn't quite put it in order. But that's an income statement account. It does not go on the balance sheet. So you should have sales $1 million, less sales return, net sales $1,050,000. So, and anytime your trial balance is balanced, then you should be, balanced. So sometimes that happens. Total operating expense 510. So the net income should have been 540. So make a note of that. Your net income should have been 540.
Sorry, can you give me 1 second while I pull up my assignment so I can look at the different, please?
That's fine. We aren't going anywhere. Now, once you got the 540, you subtract out the dividends, and so your ending retained earnings is 470.
Oh,
Your ending retained earnings was 470. So you're having graded exam, your assignments and everything.
sir.
Sales
So,
returns is an income statement account.
excuse me, sir.
Yes.
So I see where our numbers are like very a little different. So on the sales return, I had 70,000 because
I got 70,000. Oh.
Yeah, number 14.
Yeah, me too.
Number 14 had item refunded, and number 20 had a sales return also.
Okay, yeah, this person got it in real income for some reason. But yeah, it still comes out. Let me just see what they did with that. So this should have been 70,000. I'm not sure what they did with 20, what happened to this, but that was returned. So this number should have been 70. So.
All right. So.
Trying to figure out what they did with the other.
I got 2,300,000 as well on that.
This should be 70,000 here, okay?
So the net sales go to 1,030,000.
Correct.
And then
so gross profit would then be 1030. Then we add these expenses.
It's like 520 for the net income.
Well, this is 510, okay? So the net income is 520.
Yeah.
So when that happens, then you got to put a 520 here.
Exactly.
With the 70.
And so once you then subtract 70 from 520, is that 450?
Yep.
Yes, sir. Yes, sir.
So 450 should be the number for retained earnings.
All right. And let me see if I did something different right there.
So here, the person put that number here.
Right.
So not be here.
So they go down to 1 1,450,000. That's what I got.
Correct. Okay. Why you say it didn't balance then?
It did. Let me see.
Okay.
I got 1650 on it.
I think he's talking about the bottom part.
Yeah, the bottom, the total liabilities and stockholders didn't balance.
Wait a minute. Now, okay, so the rental income should have been in here. So that was return and allowance, okay? So that's what it should have been, a return and allowance. And so your net income should have been 520. You subtract out dividends, your ending retained earnings is 450. And so once you put that 450 in, I'm assuming you balance out at 1,450.
I got 1650.
Me too.
Why do you subtract the account payable?
So the total assets, I did get 1,450,000, but
Yeah, why
total liabilities, I'm getting 1.2.
Let's see, where's accounts payable?
Can we just go over the whole thing?
I wait got this.
Let me just see, maybe
And I see a negative number on there. I ain't putting no
let me
negative.
get out of this one.
And I'm hungry.
Can you do mine?
Did you balance? But it doesn't matter. Who's that one there's done?
Neely.
Or Joshua.
It's Neely. All right, here's Neely. Okay, so Neely is yours.
Oh, he got 2.3.
So you don't have them in order, Neely. But anyway, status is 2.3. And 30, subtract expenses, 520. 520 minus 7 is 450. Yes.
I don't know. He somehow still got the same number as me. I don't know.
So 450 and 650 is what? A million what?
A million 50?
Right. And that's $1,650,000.
It's 1,000,001, right?
$1,650,000. So if we add the 100 for accounts payable, the 500 for long term, that's 600,000. Okay. Then I'm assuming common stock 600. That 450 was our ending retained earnings, right?
Mm-hmm.
So we add $1,050,000 and the 600, and we get $1,650,000, which is the total assets. So it does balance.
See, on mine, I didn't have
Total
accounts
assets.
payable credit. I had it as debit.
I think I did too. Yeah, I had accounts payable as debit.
Well, I just look here, you got it as a credit. Did we overpay the accounts payable so it was a debit?
Yes. On the T accounts, yeah, I believe so.
But see, you have it over here.
On the left side.
Right.
But it's crazy because at first, when I first started, I did have it on the right side. But when I went over with somebody else, we both agreed that it goes on the left. So I'm lost.
I think that it was just an overpayment. No, but if that's the case,
When I did accounts payable, it said like I looked at the chart of accounts and it said credit, so I just listed it as a credit. That's why I did it like
but
that.
if it was overpaid like that, then yeah, that could happen. So that was the problem with how that was, how those
But
generally.
I remember what you said though, like if it was more so like on the debit side, I thought we would debit it, but like when I did that, it wasn't balancing. But when I moved it to the credit side, it balanced.
That's what I was gonna do to make mine balance.
So you're balanced now, you're saying.
Yeah. When I had the accounts payable on credit.
I think with it on the right side, it does balance though, and with it on the left, it does.
I mean, look at these accounts.
But it's on the right. It's on the left side. Why would you put it on the right?
Yeah, the T account is only
Put it on the left side. Sales returns, right? So what else would be off then if that's the case? I'll have to look at this one and see.
Yeah, that one is something
Account
else.
cash is 500. Go back to the T account. I don't know what the balance you have for cash here, but you got 500 here.
Let me see what you get for sales. Like the same thing for sales, same thing for sales.
Let's put accounts payable where it's supposed to be.
So is it supposed to be 1,450,000 or it's supposed to be 1,650,000? Because I'm confused.
Well, I'm trying to figure out why he's balancing right now. So
It looked like he missing.
let's go down and balance all the way. So this trial balance is not balanced.
So with he has cash at 500,000. Did it? I got 300,000, and so
Yeah,
mine balanced at 200,000.
So you had 300,000.
Yeah, for cash.
So now we're balanced at so Miles, you weren't balanced over here. That was, and maybe somehow you
With the cash wise, I might have to go back and double look at that. I don't know
put the
how.
cash at
I don't know
500
how y'all get 300,000.
on the other side. So what will we balance now? So now cash needs to be what?
300,000.
300,000. And if cash is 300,000, this number is going to be what? 1,450,000.
It's gonna be off. And that's why I'm confused. Why?
That's where I was getting stuck.
Those are 1,450,000. Now,
Yeah, that's why that's that too.
this is what? A minus 100,000.
Why?
Because we overpaid it.
What do you mean by that?
Let's go to the T account. We owed 300,000. We paid 400,000. We paid too much.
Okay, I didn't realize that.
Yeah. So right in here, we owe 300, we paid 400. So we paid too much. So if you overpay your bill, it's kind of like a receivable. You know, people, you overpay something, they send you the money back. So that's what they would do eventually. So now we come back to that trial balance, they're gonna pay us 100,000. So we don't owe 100,000, they're gonna pay us 100,000.
So it would be negative.
Right. Now this number is gonna be 400,000. It's 400,000. We owe long-term 500, but people owe us 100,000 back. So this is 400,000. Now we add 400 to 1,000,000. So what do we get here now?
Oh, okay.
So that's
Your balance is now. Can I resubmit it?
Not for real.
I'm still stuck on how y'all got cash 300,000.
So you're gonna have to go through the cash account and look at that. But everybody's saying that you off by 200,000 in here. So can anyone? What about this item 6 where it has 200,000? That's supposed to be here.
16, yes, 200,000.
I numbered all of them.
Number 13 doesn't go right there. Number 13 goes. One of them is on the right side of cash for 110,000. He has 90,000.
I think it might have been a notes payable question.
Yeah, that's what I got too.
Yeah, because it goes
I think
on the
it's
left.
December 3rd. Yeah.
On the debit side, it's gonna be 10,000 of it is gonna be on interest expense, and then the other 100,000 goes on notes payable on the left, and then 110 goes on the right side credit for cash.
Okay, so he doesn't have a 110 in here, correct?
Oh, okay, that's from that notes payable question with the 90 and the 10,000 interest.
Yeah.
Oh, so y'all added that. I just made it to where like it equaled up on both sides. So that's probably why I didn't put the
right. So can't do that. So go back and check your posting. Let me just see where you are.
It's going on the left. So you got to press that arrow at the bottom.
But can we resubmit it for real?
Yeah, can you like clear number 6? Because we didn't know.
We were confused.
So clear it out.
So
pretty free for the cherry on top.
You see how I did like 100,000 on both sides? I didn't know it was supposed to be 110 and the other one. I thought it was supposed to equal up on both sides.
Oh, okay.
Yeah, your interest expense is supposed to be your interest expense supposed to be debited, and then your cash should be 110 instead of 90.
Right.
Oh, okay.
All right, so we just grade these holistically anyway. So I'll look at that. But go and get it right. See if you can get it right now. So it's a good practice for you in terms of, okay, they overpaid it, didn't go the regular way. Can you, anytime you gotta, your trial balance gotta be balanced now. So if it's not balanced, it's not gonna work out. But anytime the trial balance is balanced, you should be able to balance out that balance sheet. But you got to follow some rules and everything and make sure everything is the right place. That's good. That's good for learning.
I do have a quick question though. For account, so you know how you said for accounts payable, since we overpaid, we subtract that money.
Yeah,
Does it only apply to accounts payable?
Hold on, I got to go to the door for a second. I'll be right.
Boy, white game. Yellow group, I don't know when we're gonna meet, but we need to meet.
So we're just doing one journal entry per person as a group. That's what it is, right?
I
Yeah.
think the whole group is supposed to go over because everybody has a separate number, but
We're just supposed to do it as a
it's
group.
supposed to be all together. Yeah,
I think if we
because he
all
said
just
everybody gonna get the same grade.
if we all do it and then just like compare and just help each other or whatever.
You said page 85 or 35.
Shit, I
They're
thought I
like,
I
heard.
think it's on 85.
Okay.
I thought I heard 70.
Okay, so I'm impressed. I think that
Okay, but I have like 3 questions.
so that discussion was
No,
good.
okay.
Some things, but you don't have to resubmit. If you got most of the work, you get the credit for.
Yeah.
Okay, well, my first question is, for how for accounts payable you said that we subtracted because they gave too much or whatever. Did that only
Correct.
apply to accounts payable, or does it apply to like cash sometimes, and common stock sometimes, like stuff like that?
Yeah, that could
Anything.
happen. I mean, you could overpay your tuition and fees to TSU. So if you overpay, what would you want back?
I mean, my money, but what I'm saying is like in this instance, because like accounts was debited more than, accounts receivable was debited more, and so I'm confused. I'm like,
okay.
okay.
So that was just an error in how that was written. Most times that's not going to happen. But
Okay,
but it was good in terms of you working on how to balance it. So, that payment, the second payment was too much, but in terms of you working through it and see how it impacts the balance, that was good.
Okay. And I have one more question about the group assignment.
Okay, the group
What
assignment.
if there's people in our group that does not show up, that just don't show up to class? Because I know it's a couple, I'm not trying to be shady or nothing, but I know there's a couple people that don't show up to class. And
the only people who are in the group were ones who took the quiz. So you notice there's some people in the group. So if they don't have an AJE assigned, you don't have to worry about them. So I already took that into account. So that's why, if they took the quiz, there's a check mark and it should be an AJE. So for the people who don't show up, who don't have anything, you don't have to worry about it.
it's just because we're getting a group grade, and so I would hate for the group to get a not so great grade due to
Due to what?
I guess certain people not